Hello, my name is Philip Totaro. I'm the founder and CEO of market research firm IntelStor. Welcome to your weekly dose of truth to power. Truth to Power examines data driven insights for the energy sector with a focus on renewables. On this week's episode, I'll continue what I started last week and share some of the recent analysis IntelStor's completed on asset profitability and the impact of O&M on wind farms in the USA. So, last week I talked a bit about PPA prices, asset profitability, and the benefits of life extension and repowering. This week, we dive even deeper in on profits and asset payback. We've previously released research on the total impact of production tax credits to the wind energy sector since inception. A total of more than $63 billion has been doled out to wind energy independent power producers since 1992. That investment by the U.S. government has unlocked more than $750 billion in investment in wind energy in the USA over that time frame, including over $245 billion in CapEx on wind farm projects, and the rest of it on factories to make components, as well as service companies that established here in the United States. But there are some asset owners who have developed a potentially unhealthy dependence on production tax credits. The independent power producers who have at least a gigawatt or more installed in the USA have a variety of approaches to how they leverage production tax credit revenue. There is a difference in asset profitability for companies like EDF, who only see about 9% of their revenue come from PTC revenue. That compares to Enel, who has an average across their portfolio of more than 39% of their revenue, which comes from PTCs versus PPA revenue. Now, if we resort this view to look at companies who get the bulk of their revenue from PTCs, you'll quickly notice two things. The companies towards the top of the list with the highest dependence on PTC revenue also tend to have a very small portfolio. Additionally, when we look at asset profitability, which we measure by determining how much net profit an asset owner will see per installed megawatt after they've seen a net positive return on capital on their individual projects, the average profitability across the entire US installed base is just around 1.1 million per megawatt installed. Of the top 30 asset owners, when ranked by the percentage of PTC revenue versus total revenue, who have a profitability that is at or above that market average, there are only 3 out of those 30 companies that are above that profitability average. Those who are above that profitability average are owners who tend to have a financial partner invested in that portfolio. That's the edge of having asset financial analytics at your disposal, frankly, because those financially focused asset owners are purely looking for a return on their investment, and they can choose to put their money anywhere. So giving them asset analytics like this helps them decide where to park their money. Now, if we resort this view again and look at asset owners with the highest profitability, amongst the top 30 asset owners, most are operating a small portfolio and benefiting from a high PPA price, which eliminates their dependence on production tax credit revenue. You'll also notice that of any of the asset owners with at least 500 megawatts or more, almost all of them generate the bulk of their revenue from PPA and are not dependent on PTCs hardly at all. This is important for asset owners to know, as well as asset investors who are looking to maximize their returns. An asset portfolio that is overly dependent on PTCs is simply less likely to achieve the highest levels of profitability in the United States. So, if you're looking to take the next step and position yourself with an investment in an asset portfolio, what can you do to ensure that you see a positive payback? Well, let's take a look at the profitability of assets broken down by OEM equipment being used on the project, as well as the maintenance practices. In the USA, asset owners with Senvion turbines see the highest profitability in the market. That's not necessarily because projects with those turbines have the best technical performance, quite the opposite, as I've talked about before. If you were listening last week, I noted that high PPA prices often make up for poor technical performance, and that's how Senvion really enjoys the top spot in this ranking. Their, $110 to $120 a megawatt hour PPAs for projects that have their turbines in California allows asset owners with Senvion turbines to enjoy a much higher average profitability compared to asset owners with Vestas, GE Vernova, Siemens Gamesa, and Nordex. For all the other OEMs, they show a drop in profitability for older assets, but certainly Vestas, GE, and Siemens maintain healthy returns across the entire installed base at any asset age. Projects with Nordex turbines are often placed in project sites that are not as prime, so lower average capacity factors, et cetera, et cetera. That hurts their technical and commercial performance, although not because their turbines are necessarily inferior to their competitors. You put those same Nordex turbines in the prime spots that Vestas and GE get, and you'll see the same level of performance out of Nordex that you would out of those other OEMs. Interestingly enough, though, Nordex does actually lead in one category of profitability, which are assets that were under an OEM warranty or extended warranty period, but eventually transitioned to an asset owner or third party for ongoing O&M. Nordex maintained assets that have been handed over for self-performance and maintenance have seen a $2.3 million per megawatt profitability versus GE assets, which are still under an OEM maintenance contract at just 1.6 million per megawatt, Vestas at 1.4 million per megawatt, and Siemens Gamesa at 1.3 million per megawatt. Generally, assets which are OEM maintained are more financially healthy compared to asset owners who self-perform or rely on an ISP, but that doesn't necessarily take into account asset age. When you correct for this asset age, you can see that asset owners who self-perform maintenance in conjunction with an ISP or their own in-house team do see a bit better performance than those who rely purely on an ISP that has taken over maintenance from an OEM post-warranty or after a full service agreement period. That doesn't mean that independent service providers aren't good at what they do. They tend to inherit lemons of projects, so to speak, and their job is to ensure that those assets don't significantly degrade any further from where they currently are. I'll talk more next week about asset degradation and the impact that that has. It's obvious to see that OEMs look the best, but even for older assets, they obviously know their turbines better than anybody. And more recently, they've actually got contractual obligations for high availability and asset profitability that's leading OEMs to step up their maintenance practices and improve overall asset health and financial performance. But for anybody who wants to self-perform with their own team or partnered with an ISP for transactional services or specialist services, this analysis will help you figure out who manages those assets best. Looking at asset profitability can be informative and even fun if you have the right information at your disposal. It will certainly guide you to make the right decisions that will increase your profitability. Thank you for joining me this week. I'm Philip Totaro, and this has been your weekly dose of truth to power. Follow us on IntelStor's YouTube channel as well as your favorite audio platforms. And visit www.intelstor.com to join more than 200,000 subscribers to our renewable energy data solutions. A full analysis of the renewable energy market in the USA and the rest of the world is available to subscribers. And you can register today for the next Wind Summit event in Toronto, Ontario, Canada. Visit www.windsummit.org and join hundreds of your industry colleagues to discuss the latest trends in operations and maintenance. We hope to see you there.